Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the On24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will also appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may follow along also with a PDF version of the slides that can be found in the related content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for at least 50 minutes, and second, respond to 3 of the 4 polling questions that will appear throughout the presentation. You can track your viewing progress in the Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours with a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be in that email as well. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. In the related content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the speaker bio section, you can find more about our presenters, including their contact information. If you need technical assistance, please use the help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
All right, welcome everybody to Navigating Financial Complexities with Confidence, and good morning and good afternoon, depending on what coast you're on. My name is Dan Tritch. I am a director in the Remote Services Division of YPTC. If you're new to us, you may be asking, who's YPTC? Well, we have over 3 decades of experience building stronger nonprofits. We aim to create flexible management plans and accounting solutions for our over 2,000 nonprofit clients nationwide. We are recognized as a best place to work and a top 100 firm, and we serve clients coast to coast through our regional offices and remote services. I am honored to be joined by our colleagues at Clark Nuber, Joe Purvis and Sarah Huang, and I'm going to take a moment to pause here, throw it to them, and have them introduce themselves and Clark Nuber. Joe, take it away.
Actually, I'll quick step in. So I'm Sarah Huang. I'm a tax principal at Clark Nuber. I've been with the firm for a little, almost 20 years now, and work exclusively in our not-for-profit group. About half of my time is spent working with private foundations, and the other half is spent with public charities, primarily grant-making organizations, as well as educational organizations. Joe?
Firm located in Bellevue, Washington, but we do serve clients throughout the whole country. We have, we're a top 100 firm with over 330 employees with 25 shareholders that are dedicated to remaining independent and building long-lasting relationships with our clients.
All right, this is a lot of text, so I'm going to just jump in here and go over our learning objectives and some reminders about CPE. Our learning objectives today are to identify key accounting considerations for fundraising activities and to implement best practices to ensure accuracy, compliance, and alignment between fundraising and financial reporting. For those CPE hungry people out there, I know we already went through it in the video, but just as a reminder, you must attend for 50 minutes, respond to 3 of the 4 poll questions, and again, a big reminder, you will receive your CPE certificate within 24 hours, so please be patient. And time for our first poll. How confident are you in your organization's ability to properly recognize fundraising revenue? Very confident, somewhat confident, not very confident, not sure, I don't manage this, or we outsource this function. And Joe and Sarah, generally, how confident are your clients in recognizing fundraising revenue? I feel like for us, it's a mixed bag.
I'm going to say for most of my clients, it's not an area I get a ton of questions. Most of them have the annual event that they do each year, and they kind of have their system set up and their recurring transactions, and it's pretty same as last year, I guess I'd say, unless they get like a big or unique sponsorship. That's where the questions come up for me most of the time.
We get a lot of questions on the tax side. I mean, I think that the Form 990 isn't really intuitive on how it displays all the special event activities. And so often organizations, they'll forget about certain items that need to be classified in there, or they'll not know how to come up with the numbers that is needed for the tax return. So it's a very complex area when it comes to the tax reporting, because it goes to so many different spots on the return.
Yeah, I think that makes sense, Sarah. I think your part of this presentation will be to highlight. I think there's a lot of tax complexities with regard to fundraising events. All right, so we have over 80% of our polls responded to. So it looks like, how confident are you in your organization's ability to properly recognize fundraising revenue? Very confident. We have quite a few somewhat confident up there at 53%, and then not very confident and not sure, I don't manage this, and a few outsource this function. So we have some pretty confident people here today. So let's hope that they come out of this learning something about the complexities of fundraising events. Before we jump in, I'm going to go over a high-level 35,000-foot view of our agenda. First, we're going to talk about what a fundraising event is and why it's important to define it. We'll talk about the 3 key stages in the fundraising event. And then we'll put the concept into practice through some examples and dilemmas, and wrap up with some key reminders. And with that, I'm going to pass it to Sarah to discuss what is a fundraising event.
Perfect. So when we're dealing with not-for-profit organizations, everyone seems to be doing fundraising of some form, one way or another. But today our focus isn't going to be fundraising in general. It's going to be specifically your fundraising events. So these are the things that you are doing on a one-off basis at various times during the year. So we're going to talk about that in a little bit further today, and then go into some of the different accounting reporting requirements as well as tax implications of it too. So fundraising, big picture here, what is fundraising? It is when you are doing activities with your organization to try to encourage donations. Some organizations operate purely on donations, others operate via program service revenue. If you're a private foundation, maybe you're just relying on your investment income. But here, for our purposes today, we're talking about fundraising. It's, the various mail solicitation campaigns, the capital contributions, and events as well. But specifically, when it comes down to fundraising events, we want to talk first about what is not a fundraising event before we get into more of the details of what we're talking about today. So fundraising events, they are not things that are regularly carried on. So if you are a thrift shop and you regularly have a thrift shop that's open year-round, it is generating donation revenue for you, but that's not a fundraising event because it's something that is regularly carried on throughout the year. If you are doing regular solicitation campaigns, every newsletter you're sending out via paper or via email, and it has a little click here to donate button or a little envelope in the mailing, that is not a fundraising event. That's just an ongoing campaign that you are doing. Still fundraising, but not an event for our purposes today. Gaming is never contribution revenue. We see these questions pop up all the time here. And when it comes to gaming, things like bingos, raffles, casino nights, those type of things, those are not fundraising events. Those are gaming activities. And then lastly, things that are substantially related to your organization's exempt purpose. So, if it's part of your charitable mission to be doing these types of activities, and again, that's kind of like the thrift shop example before, that could fall into here too, then that is not a fundraising event. It's your program service activity instead. So common types of fundraising events, we see these 3 coming up almost frequently, very, very frequently for organizations. And a lot of times all 3 of these are wrapped into one event as well. So the first one is just the gala, the luncheon, could be a dinner, something like that, could be a breakfast too. And that's where you are selling tickets and you may have some ticket revenue. But then there are various different levels that you could gain entry for. Maybe it's a sponsorship, or the bronze sponsor, or whatever it may be, kind of a thing. Raise the paddle, that's also done at the fundraising events. That is when individuals raise their little bid cards and then they donate at various levels. So, it could be, staggered levels from $50 to $10,000 or more, depending on the type of organization that you are. And then lastly, auctions. Everyone seems to be having an auction, whether it's online or in person or silent auction or something like that. That is where you generally get donated items or donated services, and then you are donating them, you are selling them to the people who are attending your event, and then generating contribution revenue as a result. So it's really important that we understand these different things here and know exactly what is a fundraising event versus what is just general fundraising activity, because there's different reporting requirements here. For GAAP, there's special reporting there for accounting and in-kind donations and sponsorships. For the Form 990, we have a special event area. And so that gets broken out separately. And then there may be other things that you are required to report for donations at the state and local level as well. Additionally, unrelated business income can pop up. There may be complications when you have volunteer labor and things like that. So it's just really important that you understand your activity and you understand, what the implications are for it. Because a lot of times we see people and they have these great ideas on how to raise money. And then afterwards they realize, oh, I was supposed to register with the gaming commission because we had this bingo night. I didn't do that. Or oops, we sold alcohol and I didn't get my liquor license. Or, oh, we're having this special, donated item and I didn't realize I didn't have to do sales tax on it because I'm fundraising and my state has a sales tax exemption for fundraising. So just a lot of things to think about as you're going through. So with that, I will turn it over to, I think it's Joe,
Me.
Is that right?
Yep.
And we'll talk about the different stages here when it comes to a fundraising event.
So we're going to break this into 3 different stages, kind of the pre-event stage, the event stage, and the post-event stage. But before we even go to that, I think that there are some key concepts that we need to cover for a fundraising event. Generally, with a fundraising event, you're going to have money coming in the door, revenue, and money going out the door, expenses, and hopefully the money coming in the door, revenue is higher than the expenses, right? But there's a couple of concepts that I really want to go over before we go through this, specifically in the revenue side. These are going to be at a high level. I could do a whole hour-long class on the difference between what we consider contribution revenue and exchange revenue, but you're going to hear those terms thrown out throughout this presentation. Know that the exchange revenue is whenever you are giving direct value back to the resource provider or funder. That's going to be an exchange style type transaction. You're also going to have contribution type transactions within a special event, and those are going to be whenever the general public or the organization is getting the benefits of the money really to go and fulfill its mission. The person who's providing the resources is not getting that exchange back. I'm also going to use my favorite word a few times throughout this presentation, the words bifurcate, and you could have transactions that are bifurcated between contribution and exchange. So be aware of that, and we'll talk through the nuances of that throughout this presentation. The other side is the money out the door, the expenses. There's going to be 2 different components within that. You're going to have the direct donor benefit expenses, which are going to be the cost of things like meals and entertainment that are directly going to whoever is attending that event. And then you're going to have the fundraising expenses, which are really the items that the expenses you're paying to go out and solicit the event, postage, advertising, marketing, things of that nature. And again, we'll make this more real throughout the presentation. So let's go into what these different stages are. The first stage is going to be the pre-event stage, where you're going out, you're trying to get sponsors, sell tickets, get items for the event, and go out and procure venues, things of that nature, entertainment. We're going to talk about how do you account for those when you're entering into the transactions before the event even takes place. You're then going to have the day of the event where the transactions are getting executed, or you're actually hosting that event. And then the post-event financial reporting, what are the key things to know about there? So going into the pre-event, there's 3 common things that I see my clients going out trying to do to raise funds. They're going to get sponsors for the event. They're going to sell event tickets, and they are going to procure different types of gifts for an auction. I feel like every gala I've ever been to has had a bottle of wine donated and auctioned off at some point in time. So that's the types of items we a lot of times will see donated to the organization. Whenever we have these types of transactions, we're going to get the contributions, and you're going to recognize that contribution revenue whenever it's received, or the unconditional contribution is received, meaning that the organization has entitlement to those funds. We're going to dive into that a little bit deeper in each of these different 3 sections. So the first one is sponsorship revenue. When we think about sponsorship revenue, those transactions can either really be exchange transactions or non-exchange transactions. Meaning whenever it's a non-exchange transaction or a contribution, basically what the guidance says is that you would only recognize it in that form if the resource provider, whoever's providing that sponsorship, is getting nominal value back. And I like this because they give this example of nominal value and say, like just recognizing that organization on stage during the event that is a sponsor and saying that that's nominal value. On the other side, you could have an exchange transaction where the organization is really entering into that and getting direct commensurate value back for providing that sponsorship. Some of the guidance in the AICPA not-for-profit guide there will talk about how maybe you have somebody that's sponsoring a stadium or something at a college. What it tells me whenever I see 2 examples on those far ends of the extreme is that there's going to be some gray and some judgment that needs to be made in those middle grounds, those middle spaces. So really think about what is in substance happening in this transaction. Are they doing this for the benefit of the organization or for the benefit of the general public? And if it's for the benefit of the general public, then you'll account for that as a contribution revenue. And you'll recognize that revenue whenever the conditions are met to be able to receive those funds. Many times with sponsorships, what I see is that they'd be conditioned on the event happening. And so you'd recognize it at the time the event happens. Sometimes I do see, though, where the sponsorship specifically waives a right of return on those funds, whether or not the event happens. And if that's in place, then you would recognize that revenue at the point in time that that sponsorship is procured or is obtained. So that's the sponsorship revenue. The next common revenue stream I see is in-kind gifts. Or let's actually go with ticket sales first. With ticket sales, what we see is that there's really could be 2 different components. So I'm using my favorite word, bifurcate, this transaction in which the person is getting benefit directly for attending the event, and whatever the fair value is of that attendance, such as like the meal and the entertainment, that would be broken out of the ticket price, and that would be considered the exchange revenue portion of that transaction, which would be recognized once the event happens and that performance obligation is met. The other side of it, the remaining portion, would be the contribution. And again, it follows similar guidance to with the sponsorship revenue, that there's kind of a presumption that it's conditioned upon the event happening. But if that condition is explicitly waived, then GAP says, go ahead and recognize that revenue. There's no longer that right of return at the point in time that that ticket is sold then. So you could have some revenue actually getting recognized in advance of the event in these cases. The last thing I see organizations get is procure an in-kind gift. So that bottle of wine I mentioned earlier. And you're going to go ahead and recognize those transactions at the point in time that that gift is received. So when you get that bottle of wine for resale, and you're going to originally value it at the fair value of the gift whenever it was received for the organization. One of the things I would state is really think about what fair value is for the organization to buy that on the open market. A lot of times we'll see organizations come in and say, hey, we're giving you a gift of this outrageously large amount for whatever the product is they're providing, but that's actually never what the organization would have to pay to procure that good or service. So really think about what the fair value is beyond what just the donor is telling you it is. All right, Dan, do you want to talk about how you're going to record these within the financial statements?
Yeah, you did the heavy lifting. I get the easy one. So from the recording perspective, the biggest thing we can say is make sure you're using separate accounts for donated versus purchased items. This is especially going to help you in the post-event reporting when you're trying to look at, was this event successful, right? You're going to be able to see how much you leaned on in-kind or donated items versus items you had to purchase. So this pre-event planning stage and what we would ask you to do beforehand and using separate accounts will really help you during the event and after the event more than anything. Sarah, any tax considerations here during the pre-event planning stage?
Dan, you said you're your stage was easy. I think mine's even easier from the tax standpoint. When it comes to pre-event planning, there's really not a whole lot to do. The big reminder is just make sure that you're sending out those donor acknowledgement letters for the donated items that are coming your way during that procurement period. Again, when you're getting donations of non-cash items, make sure you don't put the value of that item in your donor receipt. It should just include a description there. The only time you actually have to put a dollar value is when you're getting cash. Even when it comes to marketable securities and stuff, you don't necessarily need to put a dollar value there. Just say 100 shares of XYZ stock. Same with here for your donated auction items. Thank you for your donation of 12 bottles of wine or whatever it may be. And then again, your future self will thank you if you're keeping good records at this point in time, because when you do the tax return at the very end, we will need a lot of this detail. So keep good records along the way, so that way you don't run into trouble later.
Great. So that takes us to the day of the event. So I think the easy thing to account for here is that there's going to be the ask, right? We all go to the different events and there's going to be the ask, and it's going to say, take out your checkbooks, or I think now I hear scan the QR code most often to make those donations. Those are going to be pretty easy to account for. You're going to account for that contribution revenue at the point in time that those people are making those cash gifts. The more difficult pieces are going to be that sponsorship and that ticket sales and in-kind gift pieces. So you're going to go ahead and for the in-kind gifts, you're actually going to adjust the contribution revenue to the amount of the final auction price or whatever it was that gift generated. So in my example of that $100 bottle of wine, let's say that the fair value upon the initial receipt was $100, it sold for $200, you'd actually adjust that contribution up to the $200 amount. One of the things I'm going to let you know is that I'm going through this in a very technical aspect of how kind of the gap guidance walks you through it. I'm going to tell you for 90% of my clients, they go ahead and just see it all as one transaction and record it once at the very end for whatever was the final sales price of those goods. That might make it a little more difficult. Sarah, we'll talk about in some of the tax reporting aspects and how that's all getting recorded, but that's generally what I see my clients doing because of the materiality and the timing all being at about the same point in time. The next thing you're going to do is for the sponsorships and the ticket sales, if the performance obligations have been met, meaning you went ahead and ran that event or you fulfilled that sponsorship obligation, you're going to go ahead and recognize that earned revenue associated with those. If there was conditions on the contributions that those events had to occur and there wasn't that explicit waived right of return, then you'll also go ahead and recognize the sponsorship ticket sales or sponsorship contributions and the ticket sale contributions as those conditions are met at that point in time. The last thing I would say is that very commonly I see big deposits for catering and for facility rentals, entertainment, things of that nature. Make sure that you're going ahead, and if any of these were prepaid services because the good or service hadn't been received earlier whenever it was paid for, that you go ahead and recognize those expenditures within the financial statements, either as direct donor benefits or fundraising expenses based off the nature of the underlying cost. Again, remembering those direct donor benefits are things like the meals and entertainment that the attendees are benefiting from. All right, Dan, do you want to talk about the recording?
Yep, Joe. So in terms of recording transactions, make sure you are using event-specific codes or classes in the accounting software, and also make sure you're tracking cash, credit, and in-kind revenue separately. For this part, though, I want to hone in on that first bullet point, the using the event-specific codes, because ultimately, after the event is over, what's the question that you're going to have to answer? How did we do, right? And you can't answer that very critical question unless you have event-specific codes or classes that will help you with that post-event reporting. So making sure you have those by the day of event will really help you after the event. Sarah, what tax considerations are there for the day of the event?
Yeah, the big thing for the day of event is making sure that your receipts that go out to all your attendees from the event are correct. We see a lot of errors with this. I know when I was doing individual taxes years ago, and I would get those receipts for our individual clients to take the charitable contributions on their returns, I'd look at these receipts and be like, these are horrible. They don't include any of the information that you need. And so that was really eye-opening. Or on the other side is that they're actually including incorrect stuff. A lot of receipts, they will have the purchase price for the item, then they'll have the fair market value. And there's even a column that says tax deduction. Like sometimes it blatantly says tax deduction. Highly recommend don't have that third column there, because while yes, that probably is how you would calculate the deduction, the total purchase price minus the fair market value, assuming purchase price is more, the net difference there is going to be your donor's deduction. But there may be other things that happen that you're not aware of. And so you don't ever want to be in the position of giving tax advice to your donors. And so we highly recommend leave that column out, get that out of the software. Work with your third-party provider that's running the software if that is the case. But all you have to do as the charity is give that fair market value number and then the purchase price there, and then leave the individual to figure out their total deduction. Also remember, again, that raffle tickets or things that are being sold there at the event, those are not charitable deductions, so they should not appear in any way as a charitable deduction on that receipt too. We see that happen in error a lot too. And then when it comes to sales tax, just make sure that you're following up with all your state reporting agencies or local agencies. Again, some agencies, they have exemptions from sales tax for fundraising events. So if that's the case, then make sure to be aware of those rules, or your gaming commissioner. If you're doing some sort of gaming activity there, make sure you're following up with them as well for any reporting. Sometimes that gets missed along the way.
All right, so that takes us to post-event reporting. And some of the key things to think about from a GAT standpoint are just making sure that you recognized all the transactions associated with the event, going through any sort of pledges that were made or received as part of the event, getting those recorded within the financial statements, and then making sure that all of the different invoices associated with the event are getting captured within the system and into the books, as Dan's mentioned, in the correct dimensions. The other thing I'd let you know is that most of my clients, about 90% of the clients I work with, decide to present their special event revenue net on the financial statements, net of the direct donor benefits. So that's a presentation thing to consider, and ensuring that you have a good system to be able to accumulate that data is really important. One kind of word of caution here for you, though, is that if you do have a material amount of direct donor benefit expenses, you will need to break those out on the statement of functional expense. The items that are the direct donor benefits would be a supporting service cost of sales type expenditure, and then the remaining expenses would be those fundraising expenses within the fundraising category. All right, Dan, anything else to think about with the recording here?
Yep. So in terms of the post-event reporting, make sure you're reconciling all accounts and finalizing journal entries before you prepare internal and external reports. And I want to emphasize on that second bullet point here, it's not enough to just prepare and the internal and external reports. Make sure that you're actually reading them and digesting them and looking at them to see not only what you did great this year with your event, but what you could do even better next year. This information isn't very useful unless you're using it to monitor the success of your event and working and using it to make sure next year's event is even better. Sarah, what are the tax considerations?
Yeah, so then we get into the Form 990 reporting, which always has its challenges, and trying to take all the data that's in your accounting records and piece a bunch of other information together to get it to the tax return. And so we'll go through that in a little bit more detail in the upcoming slides. But spoiler alert, note that it is correct for your special event net income to appear on the tax return as a negative number. If it's a positive number, 95% of the time you probably did something wrong. There's one situation where it could be positive, and that's if you had a whole bunch of in-kind services. So if your catering and such was all donated, then that is a situation where you could have a positive number, because donated services are not recorded on the tax return there, but they would be part of that fair market value calculation. And so that's really important that even on your donor receipt that it's still captured in that value, because that was a value that the individuals got when they attended the meal there. And then again, we can't overemphasize how important it is to document along the way. When you get to the tax return, you're going to be pulling data from your fundraising folks. Maybe if you're in a large organization like a university, for example, you have to actually contact the different departments You talk to any university and they always groan when they have to deal with athletics. Athletics always has these fundraisers for all the different sporting events. They're always just run, haphazardly, I feel like all the time. And the accounting folks, they're just like, oh, not athletics again. I'm sure some schools have it all together, but that has not been my case over the years. So it just depends on who you're working with. And again, overemphasizing how important it is to document along the way.
All righty, looks like we're at another poll.
Yep. Which of the following is your organization's biggest challenge related to fundraising accounting? Revenue recognition, expense allocations between programs and fundraising, aligning development and finance records, internal controls and compliance, lack of staff training or resources, or we don't face major challenges in this area.
Dan, I'll tell you.
Joe, yeah, go ahead.
I feel like I'm commonly talking to my clients and they're like, if we knew how development recorded things compared to how finance accounted for different transactions, that would be great. There's always that slight difference between what's within the development system and what's in the financial system, and going through that reconciliation process. That's what I see as a big challenge for my clients, just in the whole contribution realm, not even just the fundraising space or special event space.
Yeah, I agree. Even in my former life as an auditor and here at YPTC, I think it's that C, aligning development and finance records, seems to be probably the biggest issue.
I think for us on the tax side, one of the biggest challenges is determining what the fair market value is to the donors. I know there's been a couple of questions there, even in the chat, about this. And what do you put on that donor receipt? What is in that ticket price when you sell it? You're selling a $200 dinner ticket, but what's the quid pro quo there? What's that fair market value amount? And it's hard to figure that out. There's no real formal set guidance on that, especially too when it comes to the auction items that are being sold. You're selling the condo stay in Hawaii for a week long. What's the value of that? And for you as a charity, just do your best. And I know that's not really great guidance either, but use that to your advantage and, put some reasonable method together. If you're at, have an event at a hotel, it's costing $75 a head for the people. Well, then, it's probably rounded up to 100 or something, because there's probably some other wine or other things that they're getting. Maybe there's something in a swag bag that you need to factor into. So you can use that. And then when it comes to the donated auction items that you're then selling, again, do your best estimate. You can talk to the donor and figure out, what does your Hawaii condo normally sell for? Like, how can we figure this out? And they may say, oh yeah, I have, Airbnb normally is for $3,000 a week or something. Great. Use that. Again, don't worry about getting exactly the right dollar amount. That's why you see a lot of times these things are rounded. It's $3,000, $10,000, something like that. It doesn't have to be exact. But again, just make your best effort there. And that's what the IRS is going to be looking for.
Sarah, I saw a lot of claps and confetti during your part. So I think we were right when we said you'd be the star of the show today. So. All right, so let's take a look at the responses. So it looks like aligning development and finance records, Joe, I think people are saying the same thing we are. They see that that's a major issue. Revenue recognition. And then it looks like expense allocations between programs and fundraising, which I think, Joe, at least for me, and probably you, would have been the second one I would have picked probably here. So none of these are too surprising. All right, let's move on to some examples and putting concept into practice, and I'll pass it over to Joe.
Yeah, so we've been theoretical and now we get to make it real. So in this first example here, we have the Humane Society annual gala. They've gone ahead and they're charging ticket prices of $200 a person to attend. The fair value of that ticket is $75 a person. 500 tickets have been purchased, but only 485 people attended. And there's going to be a live and silent auction component. For that auction, the organization was able to procure $170,000 of donated goods, and they went out and purchased $5,000 of goods for the auction. So what is this going to look like within the financial records? The first thing here is you're going to have a total of the $100,000 in ticket revenue for the dinner. And use my favorite word again, we're going to bifurcate that transaction, and $37,500 of that's going to be the exchange portion, which is going to be recognized at the point in time that the event occurs. You're then going to have the remaining $62,500, which is going to be the contribution component, and that portion will be earned at the point in time that you sell the tickets if the donor explicitly waives the conditionality of that contribution, meaning that the organization has entitlement to all those funds at the point the ticket is sold. You're then going to have the different expenses associated with the event. Some of those are going to be the direct donor benefit expenses, the catering, the facility rental, the entertainment, which will be can be presented net of special event revenue within the financial statements. And then you're going to have those other expenses, those fundraising type expenses. So if you hired somebody to go ahead and help publicize the event and do the fundraising aspects of it, and then postage for sending out mailers and things of that nature to let the donor base know that the event is occurring. Dan, do you want to talk about how this is going to look within the financial statements?
Yeah, so from a presentation standpoint, the first thing you need to determine is this an incidental fundraising event, or is it a major or ongoing event? If it's incidental, the gains from the fundraising event can be presented net of the direct expenses. However, if it's major or ongoing, there are really three ways to present this, but I'm going to go over the most popular one here, and it's the one we show, which is showing special events revenue and direct donor benefits gross, and then creating a net special events revenue line item in the revenue section, and then showing all other fundraising expenses as separate on your statement of activities. So those are the two main ways to do fundraising events and present them in your financial statements.
Great. So now we're going to go over to the auction component. Let's see, there the slide goes. So with this, you're going to have procured all those different goods in advance of the auction. The fair value of those goods is going to be $175,000. So you're going to have the $170,000 of in-kind gifts, and you're going to have the $175,000 in total for the different auction inventory that exists. As I mentioned earlier, whenever that actual item is sold, you're going to remeasure essentially that contribution, that gift that was received at whatever its final selling price is. So for the $170,000 of items in this example, the total sales proceeds was $285,000. So you're going to go ahead and recognize an increase in that contribution amount of $115,000 to get it to its final auction price and the proceeds that were driven from there. You then have the sale proceeds from the purchase items of $5,000 to get to a total auction proceeds of $290,000 in this example. The direct donor benefit and the other expenses are going to follow the exact same nature and presentation as Dan talked about in the previous dinner slide. And again, we're going to see that those are all going to roll up into special events revenue, direct donor benefits, and fundraising expenses within the financial statements. All right. Going on to the next slide here, we're going to look in all of these different items will be totaled to get onto the actual financial statement. So the total event's going to have raised $390,000 of revenue. You're going to have direct donor benefits of about $81,350 to get to net special event revenue of $308, which is normally the number that I see on the face of the financial statements. You're going to have the fundraising expenses of $75,500. One of the things I'm going to let you know is there is a lot of accounting guidance around in-kind contributions and the differences between contribution revenue and exchange revenue and how those need to be disclosed within the financials. At a high level, what I'd say is if this is a major material event for the organization, those are areas to pay attention to in the disclosures within your financial statements. For 95% of the clients I work with, these aren't just major activities and they're not super significant or material to the financial statements. So these disclosures just are not applicable to the organization. Really think about what is the size of your special event, your in-kind giving, things of that nature when evaluating whether or not more disclosures need within the financials. All right, Sarah, you ready to take it away?
All right, well, let's get into the tax stuff. So when it comes to tax reporting, there's certain ways that it gets reported on the Form 990. And what we do is we first look at how it is showing up on your financial statements. And so the financial statements, they will often report it as one line. You will have it often netted with the direct donor benefit expense there. And then you'll see a number, and generally it will be positive because that means that you've received a whole bunch of contributions that exceeded the benefits to the donor, which is great. And one thing I know that we've seen questions on this in the chat too, is when it comes to recording the donated auction items, I think technically there's 2 transactions, and Joe and Dan, correct me if I'm wrong, but technically you're supposed to record it at the time of the donation when that happens, and then another entry happens when the item is actually sold at the event. But in reality, Joe and Dan, is that what's happening?
No, I'd say in reality, what happens is it's always valued at whatever. There's the one entry whenever it's sold at the auction is what I see.
Yeah, and we had a question on this in the Q&A, and that's how I answered, is that typically we understand that people don't record it that way, but that it should be recorded as we've outlined here.
Right. This is the technical way, but then you also have the practical way. And so again, as long as you're getting to the right answer, then that's what matters in the end. But for tax purposes, what you'll see is we take that number there in your accounting records and we start splitting it out. Part of it goes up and is reported as contribution revenue on the return. And then the remaining portion will go down as a special event activity too. So you're going to have this net number on the financials, but then it gets broken out into 2 different spots on the return, as it has a direct impact to your public support test. Because if you're a type of organization that needs to maintain that public support test, having that contribution revenue that then boosts your support test is going to be really important. That's why we don't just capture it all as one line item on the special event section of the return. So I'm not going to go into much detail on this slide, but this can just be a reference point for you. These are all the different spots on the tax return where special events get reported. So we have it, Schedule B for the donor listing, Schedule G, which is your special event detail, and Schedule M is where you report donated items. That doesn't include all the stuff on the core form, Part 8 of the return, where it's that revenue section. And then you may even have reconciling items over in Schedule D of the return when you do your book tax reconciliation too. So lots of different spots. I know when we are doing the tax return and then we find, asking questions for the client and different things, and then we find out, oh, these numbers need to change. We're like, no, because it changes so many different spots on the return. So here is kind of just a little snapshot of what things look like on the tax return here. We have up on line 1 is where you have your donation totals, and then line 8 specifically is where your fundraising activity gets reported. Line 8 then in theory will match up with Schedule G most of the times, if you are in fact doing Schedule G for your donated auction items. And then here, just so you note, there's this little line that often gets overlooked on line 8 in parentheses there, where it says not including whatever amount of dollars of donations that are reported up on line 1C. And so that's where, again, you need to be adding these 2 items together. Take the item on line 1C for your donation items, add that into your net special event number on line 8C, and that's going to get your total net income from that special event. Hopefully that's a positive number. It should be a positive number most of the time. And then it might look somewhat similar to what is on your financial statements, but not always, since there is an additional entry that we have to do when it comes to tax purposes. But just keep this in mind that there is this different reporting here. And if you have a special event, but nothing up on line 1C, then again, that should be kind of a signal that something may also be off. Maybe you're forgetting to do the proper reclass that you need there. So moving into Schedule G, so these are taking the numbers that we had from earlier that Joe was walking through, and we wanted to kind of outline how it all goes on to the tax return. Now, if the dinner and the auction are happening at the same event, you're actually going to consolidate them for the Schedule G reporting, and it's only going to appear in one column. But we wanted to break it out for purposes of this example, just so you can see how the different things kind of come about. Line 1 here, your gross receipts, that is all the revenue that is coming from your event. That is all your ticket sales, it's all your sponsorships, it's all the proceeds from the auction items, everything that's coming in. What it doesn't include is the value of the donations that are happening in the pre-event stage, that procurement stage. So if I'm donating my condo in Hawaii, it's not going to include that as gross receipts, because for tax purposes, that's another entry that you make. You have a separate entry that you do for tax purposes where you record the value of the donation, and then you also record that expense of the donated item there. So it will net out to 0 there for your tax return. But it's really important not to overlook that stage and that step. 2 is your contribution revenue. This is the amount that people are paying in excess of what they're receiving. Line 3, that's going to be that quid pro quo number. That's going to be the value of the non-deductible amount on your ticket sales. That's going to be the fair market value of those donated auction items, things like that.
I think Sarah cut out there.
Yeah, well, we're waiting for her to come back. I think we'll move on to the next poll, and then we can have her re-summarize her points when she comes back on. All right, so our next poll, what would help you most in improving your event reporting process? A, templates for journal entries and reconciliation. B, examples of GAAP compliant reports. C, guidance on IRS Form 990 event reporting. D, better tools or software. Or E, training for staff and volunteers. Joe, where do you see your clients needing the most help with the reporting process?
I feel like it's the 990 reporting that's the most difficult in this area. There's a lot of things that are happening from a GAAP standpoint, but it feels like, we have materiality and things of that nature, like we talked about, just seeing that transaction recorded once, not necessarily needing that same level of breakout between the different contributions. So it's really, I think the nuance is really in the 990 reporting aspects of it.
Yeah, like I said earlier, I think there's a reason we're seeing a lot of hearts, thumbs up, and confetti when Sarah's speaking. So hopefully she'll be able to reconnect soon. I think that is the most difficult area for most. And like you said, Joe, a lot of times, a lot of these special events and fundraising events aren't super material. So it's not the biggest issue for a lot of our clients. Sarah, I see you're back.
Sorry about that. I know I was warning you guys before this. I was like, I've been having internet problems here in our office, and sure enough, it cuts out right in the middle of everything. But yeah, so again, special events, they're a complicated part on the tax return. If you have specific questions, let us know. But let's keep moving along.
Okay, sounds good. We're still waiting for a few more people to. Yeah, I see a lot of the celebration that you're back, Sarah. So as we get into the dilemmas, I think your answers to the tax side of things will really help people. Almost there with 80%. I'll wait like maybe another minute and then we'll just move forward here for another few seconds. All right, so let's see how we did. So templates for journal entries and reconciliations, pretty big there. And then equally as high, Joe, as we were talking about, and Sarah right before you walked on, is probably guidance on IRS Form 990 event reporting. We thought that would probably be the one that most of the people on this call would need help with.
Right.
All right, so on that note, let's get to some dilemmas and practical considerations. And we will start here with the infamous event with suggested donation. So a foundation is holding a special event dinner. In lieu of charging a set ticket price, the foundation has suggested that all attendees pay $250 at the door. Joe, what are the GAAP considerations for this dilemma?
Yeah. So first off, I always like how it's $250 at the door by suggested donation, right? It sounds like to me, in substance, this is a ticket sale, which we've gone over. And at which point you're going to bifurcate out that transaction. You're going to think about what is the amount of direct donor benefit that's happening here? What is the fair value of that ticket price? You're going to recognize that as an exchange transaction and then recognize the other piece as a contribution.
For tax purposes, I think the hardest thing here is just that the IRS hates these type of things. They hate it when you say there's no value, or even I know I saw it in the chat, when you auction something off and it has like no value. I mean, there's really no value. It's the kids' artwork that the first graders put together on this canvas painting, and so what's the value for that? It's priceless, sure. Yeah. But you got to put something there. And, for the artwork, it could be just the cost of materials, the $20 canvas, put that there for your non-deductible portion of the value there. For the special event, if it's a suggested donation and everyone's paying the $250, yeah, you should probably put $250 as the fair market value there. Or, maybe the value is something different. And so then you just assume that the $250 is the ticket price. in that case, and then the value is $100 or something for the meal that they're getting. But it gets really tricky for the donors when it is truly this like free event with a suggested and actually says a dollar amount there. The IRS doesn't like these. Are they going to do anything about it? No, there's no guidance out there. And it's just going to be an issue for the donor, when they are going through their own personal IRS audit. But as a best practice, it's generally recommended to put something there as a value for that.
And from a recording perspective, first of all, I want to say, Sarah, your answer on the value of children's artwork as priceless, that's really the only answer, right? As a father of 2 prolific artists, it's the only answer. My answer is a little bit of a cop-out in that collaboration between fundraising and accounting functions before the event planning before the event happens is really the key here, because as Sarah mentioned, there really should, both Sarah and Joe mentioned, there really should be a value to this ticket. And if fundraising and accounting are collaborating beforehand, that can be decided upon before the event and make sure that we actually avoid this dilemma rather than have to deal with it after the fact. All right, our second one, we're going to talk about the donated vacation house. A nonprofit school's annual fundraiser includes the auction of a week's stay at a vacation house. The stay was donated by the owner of the house. The house is typically rented on Airbnb for $2,000 per week. The winning bid for the house was $10,000. Joe, what gap considerations are there here?
So this is that in-kind gift that we were talking about earlier, and essentially you're going to recognize the fair value of the donated stay, that $2,000 at the point in time the donor provided it to you, and you got the rights to that asset. And then you're going to go ahead and revalue that at whatever the auction winning bid was $10,000 at the event time. So a total amount of $10,000 in contribution revenue associated with it.
And for tax purposes, we see this coming up all the time, and the donor, they're like, oh yeah, I normally charge $2,000 a week. Let me take a $2,000 deduction. Like that's what should be on my donor receipt. And no, sorry, that's not the case. Either donor receipt, when the charity is issuing that to the donor to thank them for the donated auction, it should just say, thank you for your 7-night stay or whatever on XYZ condo in XYZ location. And it's then up to the donor to determine what their deduction is. They don't get a deduction for the lost rent. That's a question that comes up all the time. I don't care if you rent it out normally 51 weeks out of the year, you still don't get a deduction for that extra rent or for that extra week that was donated. They do get a deduction for any out-of-pocket costs. So if the donor is paying for cleaning costs, or maybe they, stock the fridge before the guests come, or maybe there's, a chef that they provide or something like that they're paying out-of-pocket costs for, that's all deductible for them. But the actual value of the donated home, regardless if it's normally posted on Airbnb or something, that is not allowed as a charitable deduction for the individual.
From a recording perspective, we discussed this earlier. Technically, even if you don't do it this way, right, you should record the fair value as in-kind revenue when the pledge of the property is received. And then once the auction is over, you would record additional contribution revenue for the difference between the amount originally recorded and the amount of the winning bid. All right, discounts on venue and food. A housing organization is holding its annual gala at a local hotel. The hotel typically charges $4,000 for the ballroom rental and $20,000 for a 100-person fully catered dinner. Because the housing organization is a nonprofit, the prices were reduced by 50% for both the ballroom rental, $2,000, and the catering, $10,000. Joe, what gap considerations do we have here?
Well, I think the first one is to determine, have you actually received an in-kind gift? A lot of times what I'll see is they'll say, hey, we're giving you this huge discount to utilize our space, but then you realize that that's really just given to all organizations that are going to utilize the space. So really think about what is the fair value if you were to purchase that space for the nonprofit organization. If there is, if that price would be discounted, or there is a significant discount, kind of a intent by that organization is providing that space to further the mission of that nonprofit, then you would recognize some in-kind revenue for whatever the difference is for the fair value of that facility, for example, and the catering to what you're actually paying for those services and goods.
And for tax purposes, just remember that discounts of services are not captured on the tax return. It is only actual dollar, non-tangible, or sorry, the only tangible non-cash goods that would appear on the return. But these discounts here are generally not a tax deduction for the donor because it's a service.
From a recording perspective, you want to record the fair value as in-kind revenue and expense, and then the actual payment is recorded as a cash expense. And because we're running a little low on time, I'm actually going to skip this next one and move on to our last one, tax traps in the auction book, because I actually did see someone ask this question out there. So in this one, Business B is an auction sponsor. It receives a half-page spread and a charity's auction book for its upcoming gala. The cost of the sponsorship is $5,000. The page will include Business B's logo and address in addition to Business B is proud to sponsor this event. Present this page for $5 off your next and best car wash. Joe, what are the gap considerations here?
Well, I think the thing to know is that you're essentially giving direct commensurate value back to Business B. Business B is entering into this transaction because they get the ability to advertise within the auction book. And so there you would have an exchange transaction and you'd record that $5,000 as advertising revenue whenever that performance obligation is met of distributing out the ad as part of the auction book.
When it comes to the tax side, this is the one time when you may actually have taxable income here. Unrelated business income. I know there was a couple comments there in the chat today about that. It's really important that you understand what is being posted in that auction book. It is the qualitative versus quantitative language that's really key there. Qualitative is distinguishing yourself from your competitors, giving coupons, inducement to buy, saying that we're the best organization or we provide the best services, whatever it may be. That's all qualitative stuff. If it's quantitative, that's simply factual information on the sponsor's location, what they offer, things like that. We're a CPA firm here in the Seattle area, and we provide audit, tax, and consulting services. That's all quantitative information. It's all factual stuff. But if we start talking we're the best or we're better than these people or whatever it may be, that's when you start crossing that line and get into potential taxable advertising income. Now, if you have all volunteers that are gathering the sponsorships, you may be able to exclude that revenue due to the volunteer exception for UBI. I know that YPTC put on another webinar for UBI, so be sure to check that out if you have other questions on UBI purposes.
And in terms of recording, you want to recognize the revenue as an exchange transaction if it is indeed full income or advertising income and not as a donation, and make sure you ensure proper categorization on the financials. In time for our last poll. What would you most like to improve in your organization's fundraising accounting practices? Better understanding of gap and compliance, more accurate and timely reporting, stronger internal controls, improved communication between departments, more efficient systems or tools, or not sure yet? Joe, Sarah, what do you think your clients would respond to this question?
I think my accounting teams would always tell me improved communication between departments. Whenever they get anything wrong, it always seems like they're saying that we're unaware of a transaction happening or something of that nature. Just the information and communication systems didn't exist cross-departmentally to get the right information over to accounting to account for the transactions. So I bet you that's the one that'll win out here.
Sarah?
Yes. Can you hear me still? Okay.
Yep.
Perfect. My internet is not happy. The most like to improve your organization's fundraising accounting practices for us, I think it's always just, getting better records when it comes to the tax return and making sure that all that is set up and in place as you go along the way, because trying to piece together information that is now potentially 6 to 9 months afterwards by the time that you're doing the tax return is just a mess. So do it as you go. It's better.
All right. In terms of what the actual respondent said, better understanding of gap and compliance and improved communication between departments, which is what you said, Joe. I also saw at least one person in the Q&A say all of the above, which I think would have been the next most popular answer if we put that out there. All right, Sarah, do you want to take us home? We are a little tight on time, so I'll let you take us through a few key reminders.
Perfect. Well, thanks again, everybody, for joining us today. Just a few quick things to throw in there when it comes to tax purposes. Again, we've talked about this a number of times throughout, but just making sure that you are meeting all the donor acknowledgement requirements. There's certain things that need to be in that donor letter. We've stated them here on the slide. Don't miss those out. Again, quick reminder that if it's something non-cash that is being donated, then it's not going to put a value in there in your donated auction or your donor acknowledgement letter. When it comes to other tax forms, don't forget about potential other reporting that may come along the way, depending on what is being donated to your organization. A lot of times organizations miss out on these. The good news is that the IRS isn't too strict on the reporting here. I've never seen them assess a penalty for failing to file one of these forms timely. They just want to make sure that they're being filed. And then lastly, when it comes to state solicitation requirements, make sure that you're registered in the states. We're seeing a lot more activity at the state level with all the chaos that's happening at the federal level. And so the states are starting to step up and do enforcement efforts. So it is really important to make sure that you are registering in states where you need to be, especially if you have employees in that state, and then you're also doing donations in that state. That just kind of raises your bar, your profile level there. So make sure you don't overlook those. And with Dan, I'll leave it up to you to close things out.
Great. Again, thank you all for coming today. Our key takeaways in this session, we hope you walked away with an understanding of the full life cycle of the fundraising event, planning, execution, and reporting, and highlights on how to align financial practices with compliance and mission success. From all of us at YPTC and Clark Nuber, thank you so much for attending today, and have a lovely day.
Thank you.
Thank you.